We're getting some people coming here pretty quick, so just so I don't cut into y'all's time, I'll go ahead and do my National Mortgage Bankers spiel, which I'm sure everyone has heard. But we want to, thank you guys for being on here with us. And if anyone's interested in joining the National Mortgage Bankers Association, please reach out to me, Tiffany Wright, Matt Wright, Caitlin, anyone else that's involved. Find us on social media, on the webpage, anything like that. It has brought a lot of value to, my industry and my business personally, and everything else in my life regarding friendships, everything like that. So we'd love to have you. So if you have any extra questions, reach out to us at the end of this, give me a call, anything like that. And I want to thank our fearless leader, Tiffany Wright, for allowing us to do this. And we'll go ahead and introduce you guys, and then I'll let you guys take it away. Now, Danielle, are you going to start or Ari?
Ari will start.
I'll be starting.
Okay, perfect. So let me get on the slideshow. And so we have Ari Karen, they're both partners with Mitchell Sandler. Ari is head of litigation, labor, and employment, and Daniela is head of mortgage regulator practice group. If I could speak, that would be great. So I'm hearing someone says they can't hear anything. Can everyone hear me?
I can hear you fine.
Okay. If you can hear me, give me a thumbs up in the chat. Okay, I'm getting yeses. We might just have some technical difficulties on one end. Okay, perfect. All right, looks like we've still got some people coming in, and I'm sure some people will be, continue to come in. So, Ari, I'll go ahead and let you take it away. We're going to be going over the NAR settlement and the impact on mortgage bankers in our industry. I think this is going to be really good for all of us to hear, and that way we can maybe bring some value back to our real estate partners as well, to educate them, and so that we're ready and they're ready and everyone's ready all together. So Ari, go ahead. And you just tell me when I need to switch slides.
Great. Thanks, Casey. If you could jump forward, that'd be great. One slide. Great. So the first thing that we're going to kind of go over is trying to understand the settlement. Like many things in the world today, you get these snippets of information that are not always fully accurate, and even more so, not fully explained. And often things are explained from a certain perspective, depending on the article you read. So one thing we're going to go through today is try to understand what it's really going to mean in terms of settlement, the impact on mortgages and in the mortgage market and lenders in particular, and then regulatory considerations that lenders want to start thinking about now, because obviously if you plan ahead and anticipate, that gives you obviously an advantage over your competition. So with that, if we go to the next slide. So let's talk about the settlement a little bit. What it allows, or what it now it forces or institutes, I should say, is that the way NMLS currently works, as you guys know, or I should say, I said NMLS, I meant MLS, sorry. The way MLS currently works is that in order for a buyer's agent to get compensated on a transaction, they have to go on to MLS, and by doing so, they contractually agree to take the cooperative commission that's offered on that particular property by the seller's agent. And now that will end. So there is no longer going to be a requirement to offer or accept cooperative compensation. That is not required anymore. And in fact, MLS listings will no longer be able to be used to communicate the cooperative compensation. So while it is okay that it can be negotiated on a one-off basis between a buyer's agent and a seller's agent, it's no longer required, and under no circumstances can the MLS be a vehicle to transmit, require, negotiate. It's got to be totally separate. So the MLS is essentially no longer going to be a contractual vehicle to set compensation on a property. It's simply going to be a listing service, right? So a lot of the aspects that made MLS so critical are going to go away with this settlement. It also requires that buyers enter into buyers agreements with their agents. It also requires that sellers agents conspicuously disclose sellers agents conspicuously disclose to sellers whether any type of cooperative compensation is being agreed to. To be clear, though, one thing that is not in this, okay, and I think it's a very important note, is this requirement about the conspicuous disclosure does not exist with respect to buyers and their agents. Now, again, the buyer has to have an agreement with the buyer's agent. But if, let's say, the buyer's agent has or engages in or sets up some type of cooperative compensation with respect to a seller's agent on a particular transaction, there's nothing in the settlement that specifically requires that that necessarily be disclosed. Now, that's kind of interesting if you think about it, because it can lead to a lot of problems potentially downstream here, right? Because you could see where there'd be information that we would call UDAPT, right? And another material or information not potentially provided to a buyer. I'm not saying that's exactly what they want to have happen, but there's that hole in the donut here that you could see that could create some issues. Can we go to the next slide? So, really the way this works, it's all about the seller's agent, right? If you think about it, the sellers don't have to pay for the buyer's agent anymore, but they can if they want to, but they can't set it up as a matter of course. It has to be negotiated one-on-one with every single individual buyer's agent, right? And while the buyers have to enter into agreements with their agents, the buyer's agents can still enter into cooperative compensation essentially offline, not through MLS, and it can't be through any substitute of MLS. Like they can't put up something on their website that says, well, if you're going to work with me on any of my properties, this is how it's going to work. There has to be one-on-one negotiations, essentially, if that occurs. Next slide. I don't think, however, while this is a settlement that ends litigation for these particular parties, it doesn't end the litigation for everyone. There are a number of companies that are not going to be covered by this based on size. And then I think, as I said, we always talk often about unintended consequences, right? And I think this is an exact scenario here. Just remember something. This is a settlement between two parties in a lawsuit. Now, it's going to affect the industry, no doubt. This is not, though, a legislative act. And the reason I point that out is because when a legislative act is created, and I'm not saying it's always done right. Certainly, there's lots of examples where Congress and state legislatures get things wrong. But, the point there is to kind of at least idealistically, right, to serve the common good, to resolve issues and create laws and procedures that will avoid problems. That's not the point of a settlement, right? A settlement is where you have two parties that can come up to a point of where they can accept what the other side is saying, whether they like it or not. It's good enough, but there's no intent to quote unquote to do the common good. Here, they wanted to bring an end. They wanted to create a more competitive industry, get rid of some facets of the way the transactions worked. They felt created, antitrust concerns, monopoly concerns. Okay, and obviously wanted money from the plaintiff's side, and the defendants wanted to pay the least amount of money and preserve as much as they could. But the goal wasn't to try to, how can we figure this out so it's going to have the best outcome for the industry and avoid all lawsuits in the future? That's not how this was designed, right? That's not the incentives for the two parties engaging in it. So I think there are a lot of unintended consequences here. One I've already talked about is the potential for something to not be disclosed to a buyer. And then you see litigation potentially resulting where someone says, well, I was steered into that property. I wasn't told there was this deal on the side. I didn't know they were getting paid more. I mean, that's a possibility. I'm not saying best practices are going to allow it, facilitate it, but can it happen? Potentially, yes. The other thing I think you're going to see is that sellers' agents are going to have a remarkable amount of control, much more so than before, right? Because now Look, a buyer's agent can engage in a transaction on behalf of a buyer. And I think one thing, by the way, you're going to see is a segregation of that, because as you see some of these things happen where a buyer says, hey, I didn't know, I don't know what the compensation arrangement is, I'm not comfortable, someone's going to walk into that market and say, wait, I'm just going to represent the buyer. I'm not going to take cooperative arrangements because I'm not going to be influenced by that, but you're going to pay me X. And for X, I'm going to do A, B, and C for you, right? You're going to see different types of compensation models arising. You're going to see flat fees. You're going to see things in the, but the one thing you're going to see is sellers will inherently, because of the fact that they can offer it, right? Have more control. And that's going to mean some sellers agents are going to want both sides of the transaction, right? They'll be able to do that. You'll never be able to do that, obviously, on the buyer side. So I think people are going to focus a little bit more on becoming a buyer's agent, and people are going to focus a little more on becoming a seller's agent. And those are going to be based off marketing, so that consumers, borrowers, home buyers understand this is a person who's uniquely looking out for me. And I think that's something that's going to develop. And just remember, and this is, again, it's going to be reading the contracts like anything. Cooperative compensations can still be offered to a buyer's agent, okay, even if that buyer's agent has, for example, a flat fee. Now, the question is whether they'll accept them, whether they'll advise the consumer, and they're going to have some type of disclosures about that. Otherwise, you could imagine things going wrong. But for example, could you see a contract that says, I'm going to represent you as a buyer's agent. It's going to be, $5,000 flat or whatever the number is, and some little thing in the bottom that says, and this does not preclude us from having any other, et cetera, et cetera, et cetera, but you won't be responsible for them. Could be in there, and it's going to be something people are going to have to look out for. Next slide. I think another thing you're going to have is more DIY buyers, do-it-yourself buyers. And that, again, I think means more litigation for real estate agents. I mean, in some ways, you got to remember, this was for all, whether you want to say it was good or bad, right? This was a market that had a very set way of doing business. That set way of doing business was in place for a number of years. And the one good thing about that is there was a high level of transparency so that everybody kind of knew what the rules were, right? And you had an informed agent on one side representing the buyer, and you had an informed agent on one side representing the seller. And that avoided a lot of issues because everybody sort of knew the rules of the game, right? Now you're going to have DIY buyers come in because remember, you don't need to have a compensation plan or a cooperative compensation agreement to go see a house, right? There's going to be that ability for someone just to call somebody up and say, I want to go and see this house today. They don't necessarily need an agent anymore, right? So that's going to mean more DIY buyers. And with that, ultimately, and this is why it's going to ultimately affect lenders, let's take this through the process. So DIY buyer says, hey, I can save $5,000 or 2.5% of the price or whatever it is by doing this myself. And hey, I can figure this out, right? So they go in, they start a transaction. But as you guys know, often there are things, if the transaction does get agreed upon, right, and confirmed, and you move to now getting a loan on that property, now you're going to have somebody going through the process and not knowing those steps necessarily, and or asking the loan officer for advice on those steps or assistance. And the loan officer who's going to try to get that loan through to closing is obviously going to help them. But here's where the problem comes in, right? What happens when something isn't again, loan officers are not real estate agents, okay? Or they don't tell them something, or a deadline is missed on the real estate side of it, or not every aspect of this, they don't know to set up, an appraisal, or they don't know to get to review certain documents or do a home inspection or wherever it might be, and those deadlines get missed, right? That the real estate agent consistently watches when they do a transaction. And that is probably going to lead to more claims against the loan officer who steps into sort of those shoes willingly or unwillingly to facilitate those DIY buyers. And that, I think, that's going to really create scenarios also where I think you can have people who are saying, hey, I'll show you a home, but I won't be responsible for the transaction. So I'll show you as many houses as you want, but I'm not doing the paperwork. That's all going to be you. You're going to have all kinds of mixes of this stuff. And that's going to create new challenges for lenders because, and again, can you see it from another perspective as we go through? And why don't we head to the next slide? Because I'm going to get ahead of myself in a second here. What you're, well, I'll hold that point. I'll just stay on track here. What are some unlikely outcomes? You've heard about this is going to change home prices. I don't think so. I mean, we're talking about something that's going to be 2.5%, 3%, and it's not like no one's getting paid anymore, right? I mean, maybe on a transaction here or there, but across the board, is that going to change prices? I highly doubt it. Even if this applied to the whole industry, which it doesn't, because again, it's only with respect to certain sized real estate companies. Even if it spreads everywhere, though, I mean, you're just not talking about some people still have to get paid. Agents still going to get paid. And remember this, all of the people who have been used to doing business a certain way are still in the business and they still have the ability to do business that way. It just can't be facilitated through MLS or some other automated sort of, global system, right? It's going to have to be done on a one-off basis. But if an agent who's a seller knows the agent who's a buyer, and that often happens, and they're used to doing it at 2.5% or 3%, that's not going to change overnight, right? But I mean, yes, there'll be additional DIY buyers. There'll be more arrangements to accommodate them. There'll be new pricing structures for somebody, but that's going to be an evolution. It's going to be something that happens over a period of time. The other thing we're likely to see is a lot of innovation in technology, where we have new companies coming in with new ways to do this. That otherwise those doors probably were closed because of MLS. It wasn't set up for that type of cooperative arrangement with any of these technologies. Now these technologies can offer somebody to say, hey, we'll help you buy the house and we'll do XYZ for you, and we'll have all this information for you. And you can use us as a platform to go do and we're going to charge you something flat, right? Or better yet, you don't need a MLS anymore. You can find all the information from us, and we're a better, more searchable platform. So go through us to locate the house. I mean, I can go on and on and on, right? There's no end to the creativity here. But because of that was a pretty closed market, that will change. People have also said, well, shift where homes are purchased and sold. I highly doubt it. No one buys a house because it's 2.5% this or 2.5% that, right? Even if you were having a full savings, people buy the house for a lot of reasons. Price is certainly one of them, but it is not going to change where you want to live. And, in terms of there being an elimination of real estate agents or some enormous decrease, again, I mean, maybe there'll be some change in the volume over time, if nothing else, because of perception, right? That now that might be an endangered sort of industry / profession. But I mean, look, you're still gonna have buyer's agents, you're still gonna have seller's agents, you're still gonna have both. I think there will be some infiltration in technology. I think there will be more people doing DIY, but that's not going to eliminate agents, right? They're still going to be there. And I think while there may be some period of time, where you have increases and decreases, there's always sort of that reaction and overreaction. So, you're going to see, for example, probably DIY buyers, horror stories with DIY buyers, real estate agents coming in and saying, this is why you need to use us. There'll be some mix of that. So I think it'll fluctuate a bit. But, I don't see some massive change or increase or decrease in the number of agents. Next slide. The next slide, please.
So
we
Ari,
talked about.
I
You want to
can
jump
take
in here,
over.
Daniela?
Yeah, I can take
Great,
over a
perfect.
little bit on how this impacts lenders more specifically. So we're starting to see, our clients kind of nationally come to us, mortgage company clients, asking us, the same trend of questions. I think, the first one is, how do I as a lender enter into an arrangement with the sellers, right? The sellers agents. How do I offer incentives to consumers? So think about like builder lender closing cost model, right? Where lenders are offering closing cost incentives to builders, consumers, right? To applicants that come from that builder. And they're kind of in the purchase contract for the builder that, you know, if you go with this lender, you're going to get this discount, right? Things like that are starting to become a lot more common in relation to sellers agents, right? So lenders are partnering with sellers agents more. You know, also lenders are partnering with buyers agents. Buyers agents are coming to them, you know, perhaps they're worried now about the stake of their commissions and they're trying to figure out how they're going to get paid. And so I have had a lot of inquiries from mortgage companies asking about whether or not they can pay the buyer's agent's commissions, right? Obviously, you need to be careful that you're not paying in connection, you know, with a requirement for the buyer's agent to refer customers to that lender. But, you know, there could be ways to offer incentives to buyer's agents and pay them for their commissions. There's a lot of, you know, regulatory and agency guidelines that you need to be conscious of, though, if you're thinking about partnering with a buyer's agent like this. You know, VA has some prohibitions on paying for the agent's commission. FHA allows it, but the way you show it on the LE and the CD is important. And Fannie Mae has some restrictions on interested party contributions, especially if there's some sort of affiliation. So, you know, can you do it? Yes, it's a question that's coming up a lot more. There are some significant regulatory and agency, you know, guideline considerations to think about there. We're also, and we'll talk a lot more about this in the next set of slides, but realtors are also looking for obviously some vertical sources of compensation, right? So marketing services agreements, you know, lenders paying the real estate agents to market them, you know, are becoming more popular again. And, you know, this concept of hiring a real estate agent as a loan officer that became popular almost a couple of years ago now when FHA lifted its restrictions has come more to the forefront now. I have a lot of mortgage companies, and I'm sure you've all seen it, you know, kind of even advertising that they can hire real estate agents as loan officers and seeking to employ that model. A lot of regulatory considerations there as well. So we'll talk about that in the coming slides.
And hey, Danielle, I just wanted to throw in two other things that I've been hearing about. One is where lenders now are going out and almost using this as a potential, or thinking about almost going in and saying, hey, since you don't, you know, trying to get the DIY buyer and saying, hey, we'll help you, you know, we're going to employ a real estate agent, we'll help you actually, you know, if you end up doing a transaction yourself. So I know I would say anybody's doing, but I hear a lot of people contemplating that type of thing. And the other one I've heard is a scenario, like I said, what's related to that, where they really actually employ a realtor to work there and facilitate DIY buyers doing their own transactions. Have you heard anything about that? And do you have any sort of concerns from a regulatory perspective on that stuff?
Yeah, I mean, yeah, people are creating more of a one-stop shop, right? So they are not just hiring real estate agents to act as loan officers, but also just creating a real estate shop within the same, you know, mortgage entity. I have heard some interest in bringing everything in-house under one company. You know, certainly there are concerns there from a regulatory perspective as well. I would say the liability that you are bringing into your company, you just need to be mindful of it, right? Because when you're that one-stop shop, similar to what you were saying earlier, Ari, you're going to be the one that the consumers look to whenever there's a problem. And as we all know, there's pretty regularly going to be problems on a transaction, right? The second there's an issue with that loan, they're going to, or on the real estate side, right now, everything is going to be on you. But certainly I have had clients ask about that model because there are ways that you can offer pretty significant incentives to consumers for doing everything in-house at one place, right? Like if you use our real estate agents, you're going to get a discount on the closing costs and you're going to get, you know, a discount on that loan. So yeah, we have been hearing quite a bit about that. And similar on that point, right? A lot more vertical integration with the increase of affiliated businesses. So even if they're not bringing everything in-house at one company, there's a lot more interest now, again, in mortgage lenders purchasing real estate companies and or creating some sort of joint venture affiliated business, like a mortgage brokerage that then feeds into the lender, to kind of, again, just bring all of the verticals together. Next slide, please. So, opportunities for business ventures, we've talked about these essentially. I do want to say that we need to pay attention to some of the guidance from the CFPB on RESPA that has been coming out, particularly about technology disruptors, right? Like shopping for a mortgage online is something that requires a lot of regulatory review before you kind of, set that up. So where we think MLS might take less of a prominent role in the future, and other technology disruptors where you can kind of shop for a home online might become more prevalent. I've even had mortgage companies kind of looking into doing it themselves, right? Or partnering with real estate companies to create a technology venture. You need to be careful about how you set those up. How is the mortgage going to be displayed? How are the mortgage options going to be displayed? Are they being displayed based on how much somebody is paying to display, their mortgage entity versus another? There's been a lot of RESPA guidance on that. And essentially, in some ways, the CFPB alluding to the fact that, online shopping for mortgages in and of itself creates a significant amount of RESPA risk, because the consumer may not be aware that the way entities are being displayed is based on how much those mortgage companies are paying for the display, what the business arrangement is behind how your mortgage entity is displayed on technology is very important. And the CFPB has highlighted that recently. Next slide, please. So let's dive into some of the specific regulatory considerations with each of these business ventures that might become more prevalent, right, given the NAR settlement. So an acquisition. So to the extent that a real estate entity is going to affiliate with a mortgage company, and creating an affiliated business, so creating a separate third-party entity like a mortgage brokerage, for example, right, where the real estate entity owns some of it and the mortgage company owns some of it. The first thing to really be thinking about is RESPA, and are you setting this up, essentially just so that it can be a way of disguising referral payments to the real estate agents for sending loans to that mortgage brokerage company. That's the first thing that will be highlighted if you're ever under a regulatory review. So, the company needs to be set up as its own company, has to have its own employees, has to have its own licensing, and there can be no required use. So importantly, the real estate entity can't require the use of that mortgage brokerage in order for the consumer to purchase a loan. And there need to be disclosures about the fact that the real estate, agent or company is affiliated with this brokerage. Licensing requirements. So this isn't as simple as just, kind of using the mortgage company who's one of the owners, one of the affiliates of this joint venture. You can't just use their license and set up a little mortgage brokerage, right? There's no net branching per state requirements, per state licensing requirements. That entity is required to get its own licensing, and if it's going to lend, its own approvals, right? So its own FHA, its own Fannie, its own approval. So it has to stand alone as its own entity. The other thing I would say is for mortgage companies that are considering expanding their footprint by nature of an affiliation with a real estate entity, you need to think about the potential fair lending risk associated with that affiliation. I have a lot of mortgage companies right now looking to acquire either other mortgage companies or some sort of real estate affiliate. And to the extent that significantly impacts where you lend, and it means that you're going to be lending in maybe higher end areas, right, depending on where that real estate affiliate is located, you need to be careful that you're not creating some redlining risk, where now your footprint has increased in a high-end area, like a high-income area, and if that area happens to border a majority minority, historically underserved neighborhood, and now you're lending a lot more in that footprint generally, but not necessarily in a majority minority neighborhood, you can create some serious redlining concerns for yourself. And as we all know, I'm sure you've all seen in the news, those settlements, those investigations are not lightening up. The CFPB and the DOJ are aggressively investigating redlining. So that's just something to think about if you are thinking about affiliating with a real estate entity. But quite frankly, in any sort of acquisition environment, you need to be thinking about the redlining risk that you could be creating for yourself. Next slide, please. Okay, dual employment. So, as I mentioned, the other thing that's become really popular, particularly because real estate agents are, nervous about their commissions, is real estate agents becoming loan officers, becoming employees of a mortgage company. FHA used to have conflict of interest prohibitions on the agent acting in a dual role on the mortgage transaction and getting compensated on both sides of the transaction. When they lifted that restriction in December of 2022, a lot of mortgage companies actually started piloting this sort of real estate agent loan officer model. But what we need to be careful of, and there's a lot of regulatory considerations to take into account here, are if you are particularly if you're a state licensed mortgage company, there are some states, Tennessee is not one of them, but if you're lending in other state footprints, you need to be concerned about whether or not the state mortgage licensing laws allow you to do that. So there are a couple of states that just prohibit the model altogether. You can't work on both sides of a transaction. Outside of that, if your state does allow for it or is silent on the issue, which allows for this, there are some real estate laws that may restrict that dual role activity. And, even though you're not hiring them to be real estate agents at your company, because they are real estate agents elsewhere, they are subject to those real estate legal requirements. And if they're breaching them, it could involve your mortgage company in an investigation, right? That's the easiest way to become the target of an investigation, is work with someone that's doing something illegal. And so you don't want to involve your mortgage company and raise the level of risk. So you do need to, at some level, at least look at what the real estate requirements are in the state that you're thinking about hiring one of these potential real estate agent LOs. USDA does not allow this, so they cannot work on USDA loans on both sides of the transaction. They came out with an opinion on this shortly after FHA changed its mortgagee guidelines. And I've been recently actually hearing that a fair amount of investors will not allow this dual role. So you need to check with your investors to make sure that they will purchase the loans that you are originating with these real estate agent loan officers. Bottom line is lenders need to establish a policy on state footprint, the type of real estate agent that you're going to hire. Are you going to hire broker owners? Are you going to hire just referral agents or, any agent, right? You really need to think about establishing a policy of who it is you want to hire, and also what's your state footprint going to be, and then, determine what the regulatory risk is from a state perspective, from an investor perspective, from an agency perspective. There's also going to be a fair amount of privacy training, and marketing practices, because these real estate agents are not used to working at a mortgage entity, a financial institution that is heavily regulated. Mortgage is so different from real estate, even though they're so related, right? And the concept of information security and how you use information in the mortgage context is very different than how realtors are allowed to take and use information. So you need to be careful of that. Next slide, please. So we can go into just, I can go in at a very high level because we have a lot more slides to get through, but essentially, RESPA prohibits compensation for referrals. So one of the first steps you need to take if you're thinking about hiring a real estate agent as a loan officer is to make sure that that loan officer is actually going to be performing services. You cannot hire the real estate agent just to sit there so that they can become a W-2 employee of yours and get compensated on the transaction legally. But in reality, all they're doing is just referring the loans from, for their purchasers. So the LO actually has to, that real estate agent that's employed by you actually has to take the application, has to do work, has to interact with the consumer as a loan officer. They can't just be there sort of as a sham. And, can you set them up as teams? Sure. You can set them up with a senior LO, that has some oversight of their loans, because they might be a new loan officer who's never taken a 1099, a 1003 before, right? So it is very common to set these people up on, junior, senior LO teams, but they cannot just be referring everything over to that senior LO. They do have to be taking the application and conducting the basic origination services on that loan. From a RESPA liability standpoint, this dual employment and sham arrangement setup has been reviewed. In fact, there was a consent order from the CFPB in 2014. It wasn't a big splashy millions of dollars consent order, so it didn't get a lot of popularity. But essentially what they found was that W-2 employees were being hired by a title company when they were really just contractors in order for the title company to pay them for referral fees. So, they found that that was a sham arrangement, and essentially every commission that they paid their W-2 employees on those title contracts was found to be an illegal referral fee. And so, it became very costly for Stonebridge Title Services because they had to, each of those was deemed to be a violation of RESPA. So if you're going to hire someone, again, make sure that they are actually originating the loan, they're on the 1003, and that they're doing things like other LOs do, right? Company sales meetings that you would be required to attend, trainings, they have performance goals, they have supervision meetings, just doing the normal LO sales activities that you would expect for your sales force. Next slide, please. RESPA and UDAP. So obviously, if you're going to have that loan officer real estate agent, that as a real estate agent, that individual cannot require the use of the mortgage company that they work at as part of whether or not a consumer can purchase a home or not from them, right? So they can't require the use of your mortgage company. There can also be no exclusivity of marketing in that real estate office required just because you hire some of the real estate agents as your LOs. Obviously, they're going to refer the mortgage company, right? They're going to market themselves as a loan officer at the mortgage company, but they cannot require the use of the mortgage company. And there's a big difference between requirement and making a referral. So in this case, you just want to make sure that they're clear. They can't tell that consumer that they have to go to your mortgage company. Disclosure, there are a lot of state requirements for states that allow this. They usually have their own state disclosure that needs to be given to the consumer if they're going to act on both sides of the transaction. But some states don't have that requirement. And regardless, I always recommend that it's good practice to disclose to the consumer that there's a business relationship between that real estate company and the mortgage company so that there's full transparency and that the consumer can choose whether or not they want to end up going with the mortgage company that the real estate agent's associated with. And also clear marketing policies, right? You want to make sure that these real estate agent LOs know that they have certain guidelines about how they can market the mortgage company, because what you don't want is a realtor going out there and not making it clear that they're affiliated with your mortgage entity, and trying to and basically branding everything in their personal brand as related to your mortgage company, because as you know, there's a lot of state and federal requirements for mortgage lender marketing, right? And even just the lack of a particular disclosure can implicate you in a lot of liability if you're not putting that disclosure on your marketing. So you want to make sure that the real estate agent is really clearly trained on what they're allowed to do and how they're allowed to market you as a mortgage lender. Next slide, please. I already mentioned this, and I don't think we really need to get that deep into it, but the LO has to be, that real estate agent has to be licensed as an LO. They need to be licensed before they come on to your company. So they need to be licensed and sponsored prior to printing them business cards or printing any marketing as a loan officer at your company. It's very, real estate agents are also salespeople. So once they know they're going to start working with a mortgage company, they're going to start marketing themselves and, potentially, again, doing marketing that's outside of the boundaries of what you want your mortgage company to represent. And so it's important that you not start printing that stuff until they're fully licensed and sponsored and on board with your company. Depending on how you set up where that real estate agent works, and Ari can talk about that a little bit further because there's some employment and labor concerns surrounding that. A real estate office could require licensure, right? Similar to like if you have a desk rental at a real estate office, if that person is actually taking applications from that office, it could mean that that real estate office requires licensure. So, it might be a good idea to have your LOs. And again, Ari will talk about this further, but it might be a good idea to have these LOs be required to conduct their loan officer applications, their services outside of that designated real estate office. And I do recognize, by the way, that most applications are taken online. I know there was a comment about that. Nobody really necessarily needs to go to an office to take an application. Very few people do that. And a lot of the work is done online, right? But there is someone that's going to have to be responsible for that 1003. There's someone that's going to have to educate the borrower and speak to them about, what loan options there are for them, all those regular LO services that loan officer has to conduct. It can't just be, okay, submit your application online and hand it off to somebody else, right? And in the case of a loan officer that's also a real estate agent, it's very important that you actually document that. With a regular LO, it wouldn't matter, right? It wouldn't matter if they're a big producer and they have their team doing most of the work on the loan. But in the case of when you're trying to overcome the implication that this LO is only working at your company as a sham to disguise referral relationships with that real estate company, you do need to prove it. So you want to make sure that you actually have extra documentation on the file that this LO is actually the one working with the consumer and doing the loan, so that that sham implication is mitigated. And then we did talk a little bit about information security. And again, you just need to have some strong provisions in your contracts, making sure that they know that they're held to a certain standard for making information secure, and when and how they can use that information, particularly if they leave your company, what is required of them to return that information, and how to keep that information secure and not just go ahead and use it at their real estate office. And then, they need to be trained on that as well in onboarding. Next slide, please. So there's a lot of, as I mentioned, employment and labor considerations that Ari, you can take the handle on and kind of walk us through this next set of slides associated with this model.
Sure, thanks, Daniela. So, under this model, just, you still have to have employment laws that would apply to any other employees, but because of the unique relationship here, and in particular, the fact that the real challenge is, when does someone stop becoming a loan officer and start acting as a realtor? So take a real life instance. Realtor LO, right, is showing a house to a prospective buyer and then says, hey, are you pre-qualified? Are they working as an LO now, or are they working as a real estate agent? I don't know, right? No one could know that. And when did that stop and when did it start? So if you think about just something simple, paying them hourly, how do you track hours? How do you figure out when they were doing which one, if not both, right? That's going to be very difficult to track that. And the problem is beyond the fact that you're talking about real estate agents who have never had to track their time because they typically don't get paid hourly, so how are you going to even enforce and make them do it? It's going to be impossible. For any of you guys out there, you probably know how difficult it is just to get loan officers who do this all day long and should be used to it by now to track their time accurately. I query as to how many do that, right? But the point being, now when it's a real estate agent who's doing this at a part-time capacity, forget it, right? And even if they could, again, how do you figure out which is what and how do they do it consistently? It's impossible. So that's a real problem in having somebody paid hourly. The other thing is what do you do about, if you are paying them hourly and you somehow figure out this recording of time thing, how do you deal with the agent who, does a loan here and there, right? But that's not their full-time thing. That's not what they want to spend their time on. If something falls on their lap, sure, I'll take it, but I'm not going to go crazy about this. And then, do you want to, if you keep paying them hourly and they're not producing loans, do you want to fire them? I think a lot of lenders would be very reluctant to terminate a realtor for a lot of reasons. Next slide, please. So, how do you kind of deal with that? And this is where I think that the thing is, there's a couple of steps, but one is rely upon an outside sales exemption. Now, an outside sales is still a W-2 employee. Okay, so you're not getting into 1099s or any of that stuff. They're true employees. And as Danielle was saying earlier, being a 1099 would be a real problem because, the whole uh, uh, that the title case, I think it was Meridian title and the fact that, then you'd have a potential RESPA violation. So you've got to have them as a W-2 employee. But so this would still allow that. They'd be commission only. In most states, there is an exception in Arizona where it might not work, but everywhere else it probably would. And the thing is that, what you just have to make sure that they're spending a majority of their time, not all their time, okay, but a majority of their time outside any place of employment of the employer, essentially doing, soliciting loans. And, that shouldn't be too hard if you're talking about a real estate agent. I just gave you the example of when they're out, how do you track whether they're acting as the realtor or the loan officer? In this particular case, it actually works to your benefit because they're probably doing both, which is the truth, right? And if they're engaged in that activity outside, and that's the majority of their time, which it should be for a realtor in most cases, then they're going to meet the outside sales exemption in most cases. Again, licensing in the real estate office can cause some challenges, but I think that if you write the contract the right way, and if the understanding is correct, the reality is, at least, as of now, realtors are still going out and going to go out, meet people at homes, and that's when they're going to be doing their soliciting of potential clients. So I think you should be okay. I mean, it's something you'd have to think about and consider, but you should be okay on that if you set it up the right way. Now, one thing you don't want to do is start giving duly employed LOs leads, right? Because then what can happen is they can just start sort of relying upon those and they don't necessarily have to sell. And if what happens then is they just take those leads and kind of they supplement themselves, but they don't really bring in any of their own clients now, all of a sudden they can convert to an inside sales employee, right? Because think about it. If you have leads, you don't have to go out and solicit. You can sit there and dial for dollars, right? Obviously, that's not the intention of any of this. I get it. But if you just started doing that, it can weaken that outside sales exemption because you don't need to go outside. The benefit here is if the only way they're selling loans is by going outside, meeting the borrowers when they're showing them the houses, these assumptions I'm making about outside sales can probably work. If you start giving away leads, that can be problematic. Next slide. The other thing is, I always suggest these people be part-time. And I don't suggest this for all lenders, right? There's a lot of dangers with this if you just start converting full-time to part-time. You don't want to do that. But in a context where somebody else is fully engaged in another profession, there's no question about it. And, that is their job and that's what they were doing and that's what they're going to continue to do. It's a reasonable assumption this person is going to now only work for you on a part-time basis. And being on a part-time basis, that limits you exposure to overtime claims. It limits the number of hours they'd work. So even if your outside sales exemption failed, you're not going to be getting into big numbers, right? Because you're not going to be getting to overtime or anything. And the other thing is that you avoid benefits, and you clearly avoid benefits, right? So you don't necessarily have to worry about health insurance and all these other things because most companies and most insurers require full-time employment to be eligible for coverage. Something you want to check about, but that's again, something you want to button up through this part-time because again, as I said before, when you can't really track what they did and when they did it, did they qualify for benefits? Were they working full time? Did you not give them the benefits when they were eligible? Did you give them benefits when they weren't eligible? These can all have serious kind of problems downstream. So you want to make sure, and that's why by designating these people part-time, explaining the context around it, having all that kind of buttoned up in your agreement, that's pretty safe and it kind of covers coming up with bases. Again, I want to just reiterate, I don't want anyone to get the impression of, oh, this is a great idea. I'll just change all my full-time loan officers to part-time so I don't have to give them insurance. And do not do that, okay? Because you can get sued for that and it could be a disaster of a lawsuit. Do not do that. I'm only suggesting that in a certain context where they are gainfully and fully employed in another position with another entity, then it's a fair and reasonable assumption they're working for you part-time. To simply take all your full-time people and convert them, everybody knows what that's about, right? So don't try that. You would run afoul of a number of laws, federal and state, and can have some very serious repercussions. Next slide, please. I kind of covered this mostly. This is really talking about health benefits. We're just talking about benefits in a minute, so we can jump to the next slide. Now, one other thing is also, Daniela talked about this a little bit as well, and I just kind of want to touch on it. Just remember this, okay? These people have to be trained and they have to know what they're doing. In the sort of that model that I know some people are kind of using out there where, oh, we'll just have them refer us loans. They're beyond the regulatory aspects. The real problem here is this. Right now, when a loan officer, I should say a realtor, is talking to someone and says, oh, my borrower is going to qualify, no problem. Or, my client's going to cover, be able to get financing, no problem. You don't have to worry about them. They're working with a great lender. And who cares, right? They don't speak for you. That's just a realtor out there making their case for why they should accept the bid from their client. Now, as soon as now they become a loan officer, that representation, oh, don't worry, they're going to be able to get financing. All of a sudden, again, you don't know what hat they're wearing at the moment. And from the other person's perspective, they're going to assume, well, I guess they're talking to me as the lender, which means you're guaranteeing it, which means if something goes wrong in that transaction, guess who they're going to come after? And, right now they really can't, because you just say they don't work for me. I don't know what they said. That's not my problem. Well, now it is going to be your problem, right? I've also seen, even a scenario where I got a call where somebody, a real estate agent had put up on their MLS listing and said, in order to apply or not apply, in order to submit a bid on this home, I guess that was very sought after, you have to first get pre-qualified with me at my lender company. I'm sure the lender didn't know about that, right? But that would be obviously problematic. So you've got to really make sure that these realtors know what they're doing and aren't just referring stuff. Because if it's just a referral, they don't understand the industry, they don't understand the risks. Those problems are going to become yours. You can have liability there. So there's supervision and training of these individuals is extremely, extremely important. Next slide, and you should track it too, because again, that might be a way for you to avoid some liability, and certainly would be important to regulators. The other thing is, if you have current agreements with loan officers now, do not, under any circumstance, use them for your realtor partners or your realtor dual realtors. The reason being that things like the minimum wage, the classification under the Fair Labor Standards Act, benefits under the Employee Retirement Income Security Act, benefits under the Affordable Care Act, RESPA liability, all these things that are not really that important, or are conversely, in the case of actual employees, extremely important, right? Depending on which way you want to look at it, they're going to be different because of this particular setup. And if you just plug one in and throw that contract at it, for example, imagine not changing the promise that, oh, we're going to provide you health insurance, and you don't, and that person gets sick. You have a contract that said you were going to do it. You didn't do it. Guess who's paying for that illness? You are, out of your pocket. That's an example of, where we talk about massive, massive liabilities based on not having changed the contract correctly. So start from scratch, use a different agreement, have somebody do a different agreement for these individuals. Next slide. Daniela, do you want to jump into this, or should I keep going?
Yeah, no, we did talk a little bit about technology disruptors, right? Some alternatives to the MLS. I think where, I just want to make sure we highlight in this presentation is there could also just be more online lead generation, right? Even if it's not a specific shopping platform where you're displaying your mortgage company, or even like a platform where you're displaying where you can purchase a home, right? Alternatives to MLS are not necessarily required. And what I'm thinking is that there is just going to be a lot more lead generation on the real estate side, and therefore more opportunities for mortgage lenders to purchase leads, specifically from real estate entities and or former real estate agents that are now looking into online lead generation as another stream of revenue for them. There are already real estate agents and real estate shops that have set up their own kind of lead generation, online platforms. And so I just want to be clear, because obviously real estate agents are good at generating leads, right? They're good at branding, and they're good at getting, consumers to the table. And so if you are going to engage with lead generators, whether it's with a real estate entity, real estate agent, or not, just be aware that you cannot pay for referrals, right? The difference between a lead and a referral in the eyes of a regulator is that a lead is just data. It's just raw data. You're the one that markets to that individual. You're the one that gets yourself in front of them. There's no affirmative influence from any other individual to use you, right? There's no, this is the best, loan officer in town. This is the best mortgage company. You should use them. A lead is just raw data. You do with it what you like. And you can pay for leads, but you cannot pay for referrals. You can't pay for anybody to influence the selection of that consumer to go to your mortgage company. So that's the first thing. When you're thinking about lead generation, you need to be worried about, are you paying for a lead or are you paying for a referral? And then the other thing is also, with lead generation of any sort, there is fair lending risk, right? How are those leads being generated? What's in the background? And the CFPB has spoken a lot about this recently and has put out some guidance that they are really looking at these, lead generation entities that use algorithms to target certain areas or certain demographics from a fair lending standpoint. So just be aware that if you're using a lead generator, it could create some fair lending risk. You should know how they are, getting these leads, how they're generating them, and you need to kind of dig under the surface. And also think about, where are you asking them to generate leads for you, right? How are you instructing them, and does that create any fair lending risk? Next slide, please. And then the last piece, and I think this is the last slide for us today, is just marketing services agreements. As we mentioned earlier, we think they're going to become more popular again. We're already starting to see a lot of questions about it. With marketing services agreements, you have to pay for the marketing opportunity, right? For your opportunity to get your brand in front of consumers through that real estate entity, if you're paying a real estate entity on an MSA. That means you need to pay fair market value for the actual marketing. You're not paying for them to refer to you. If they refer to you, great. That's not what you're paying them for, right? You're paying for an opportunity to display your brand there. So it really should be consumer-facing marketing that you're paying for. How does your brand get in front of that consumer? You also need to make sure that you're only paying for what you're getting for. So if they're not providing you with that opportunity to brand, or the services that are outlined in an agreement, which, by the way, they should be carefully outlined in an agreement so you can audit it. If you're paying for something that you're not getting, the implication is you're going to be paying for a referral if you're paying a real estate partner that's in a position to refer. And also no exclusivity. So this real estate entity can market anyone, not just you. You're not paying for them to exclusively refer to you, because that can be seen as a steering concern as well. Next slide. And I think that just brings us to the end of our presentation. Ari, I don't know if you have any other comments. Or if Nashville MVA has anything else to add. But thank you so much for the time today. We really appreciate the opportunity to talk to you. And if you have any questions, you can always reach out to either myself or Ari.
Thanks, everybody.
I was muted. Thank you guys so much for that. I know I learned a lot and can't wait to discuss some of this with my realtor partners and kind of just see where they're at on this and what they think, and hopefully educate them a little bit more on that end. Does anyone have any questions while we, I know we're right on time. Does anyone have any questions for Ari or Daniela before we log off? If not, feel free. If you don't want to speak up now, feel free to, oh, it looks like Derek has a question. I'm not sure if I can unmute you. Caitlin might have to do that. I see your question in the chat regarding the meeting will be made available to attendees. I'm not sure if it will be or not. Caitlin, Daniela, this will be up to you guys if you want us to make it public.
It's up to Daniela and Ari if they're comfortable with the recording being shared.
Yeah,
and we can definitely get that out to everybody.
I think that would be fine, Caitlin. If people are interested in sharing, we're good with that.
Okay, awesome. Thank you guys so much. Anyone else have any questions before we head off? If not, thank you everyone for joining. And like I said to begin with, if you had any questions regarding National Mortgage Bankers Association, or you wanted to join or just learn a little bit more about us, obviously you can see the value that it brings to our industry. So please reach out to me or anyone else in the organization to, let you, any questions that you have, we'll answer, and we'd be happy to have you. Again, Daniela and Ari, thank you so much, and I will give you guys back the rest of your day. Thank you everyone, and have a great day.
Thank you.